Wall Street. It's a cornerstone of the global economy, we all know that, but what are its true foundations? In this Spinbot Insights Explainer, we're going to explore that very question, looking at it through the lens of Jordan Belfort's historical analysis. And what we uncover is a story of deliberate control, right from its very beginning.
The analysis kicks off with this incredibly powerful metaphor from journalist Matt Taibbi. This image of a vampire squid isn't just for shock value. It's used to frame the entire central idea that Wall Street wasn't really built for shared prosperity, but for extraction.
At the very heart of this argument is something called the Wall Street fee machine complex. This is described as this coordinated system in alliance, if you will, that wasn't built to create value for you, but to maintain its own control and systematically strip wealth from the public through fees and deception.
Now, to really understand how a complex like that can operate today, the analysis argues we have to trace its roots. And the foundations of this system of control weren't laid down in recent decades. No, we have to go back centuries. It all started, believe it or not, with a literal physical wall. From there, the street's evolution was really marked by these key moments of consolidation. And all these steps eventually led to a formal exchange, and finally, a single index to measure its collective performance. The 1792 Buttonwood Agreement is really singled out here as the critical turning point. You see, this act created a private exclusionary club. It was fundamentally designed to make sure that its members, and only its members, would control the market and all the profits that came with it.
For more than a century, this closed system just operated without any real challenge. Its first great test, though, came in the 1920s. This was when a wave of just unprecedented public enthusiasm brought millions of ordinary people to Wall Street's gates for the very first time. You know, the Roaring '20s created what you could only call a perfect storm for speculation. You had a booming economy, the rise of mass media, and this powerful fear of missing out, all of it combining to fuel a kind of mania among a generation of Americans who were investing for the first time in their lives. And the main tool that this new wave of investors used was something called buying on margin. It was an incredibly tempting offer. For every $1 an investor put down, they could borrow 9 more. This meant they could control 10 times the amount of stock, which magnified their potential gains, but, and this is key, also their potential losses. But all of that extreme leverage created a really precarious trap. Even a minor drop in a stock's price could trigger what's called a margin call, a sudden demand for more capital. Most retail investors couldn't meet that demand, and the result was the forced sale of their stocks and a total loss of their investment. So, with this widespread use of borrowed money, you had this incredibly fragile system, just balanced on a knife's edge. This deep structural weakness meant that when the market finally did turn, it wasn't going to be a simple correction. No, it was going to be a catastrophe. The first shockwave hit on October 24th, a day we now call Black Thursday. A panicked sell-off was only stopped by this last-ditch coordinated intervention from Wall Street's top bankers. They managed to restore a kind of fragile temporary order. But that relief was incredibly fleeting. On what became known as Black Monday, the selling started all over again, but with even greater force. And this time, the financial establishment didn't step in. This time, there was no rescue. The final blow came on Black Tuesday. It was a day of just catastrophic losses that shattered any confidence that was left and started a downward spiral that would go on for the next 3 years. It's hard to even comprehend the scale of the devastation, which took 3 full years to unfold. From its peak in 1929 to the very bottom in 1932, the market lost a staggering 90% of its value. This wasn't just a number, it represented the complete annihilation of an entire generation's wealth and savings. In the wake of such profound devastation, one conclusion was just inescapable. The long-standing tradition of Wall Street policing itself had completely failed. So the federal government decided that a new authority, one that was independent of the financial industry, was now required. The result was the creation of the Securities and Exchange Commission, the SEC, back in 1934. This new federal agency was tasked with enforcing securities law and, really crucially, protecting investors to try and restore some faith in the financial markets. But here's where the story takes one final provocative turn. The source material ends this history with a question. To police Wall Street and protect the public, who was chosen as the SEC's very first chairman? The answer, well, it reveals a deep irony about the true nature of this new regulation. Thank you so much for joining us for this historical analysis. If you found this useful, please do click that like button and subscribe to Finbot Insights for more explainers on the forces that shape our financial world.